Welcome back to Intelligent Investment Today, the podcast dedicated to cutting through the market noise, hype and speculation to concentrate on what really matters in investing. Long-term value, strong fundamentals, and thought-provoking decision-making, guided all the time by the enduring principles of value investing as set out by Benjamin Graham. Today's episode invites us to think much further ahead than most investors ever do. Instead of asking what might perform well next quarter or even next year, we're going to explore a much more ambitious question. What kinds of companies could realistically survive for the next 100 years? In a world of rapid technological change, shifting consumer habits, and constant disruption, very few businesses endure for a full century. Yet some do. And when they do, it's rarely because they chased trends or took excessive risks. It's because they built businesses with strong foundations, durable advantages, and disciplined financial structures. This is what we'll call the 100-year stock test. If a company were to exist and thrive for the next century, what qualities would it need? What business models, financial traits, and strategic behaviours make long-term survival more likely? By the end of this episode, you'll have a clearer framework for identifying companies that aren't just built for growth, but for endurance. To begin, we'll consider how rare long-term survival really is. So sit back, strap in, and let's get right down to it. It's an undeniable fact that most companies don't last. Many disappear within a decade. Some fall victim to competition, others to poor management, excessive debt, or technological obsolescence. Even large dominant firms can vanish surprisingly quickly. Think of companies that once seemed unstoppable, but are now gone or irrelevant. Their failure wasn't always due to bad products. Often it was due to fragile business models, financial weakness, or an inability to adapt. Surviving a century requires more than just success. It requires resilience. Resilient companies tend to share several key characteristics. First, they operate in industries with consistent long-term demand. Second, they possess some form of competitive advantage that protects them from rivals. Third, they maintain conservative financial practices. And finally, they adapt to change without abandoning their core strengths. Let's explore these traits more closely. The first requirement for long-term survival is durable demand. A company cannot last 100 years if it serves a temporary or rapidly fading need. Businesses tied to essential human activities such as food, healthcare, energy, transportation, and basic infrastructure tend to have the strongest foundations for longevity. People will always need to eat. They will always need medical care. They will always require transportation and utilities. Companies that serve these needs operate in markets that don't disappear, even when technologies evolve. Consider businesses like food producers, pharmaceutical firms, utility providers, and consumer staples companies. Their products may change over time, but the underlying demand remains. The second requirement is a competitive advantage, often referred to as an economic moat. A moat protects a company from competitors by making it difficult to copy its business model, its pricing power, or customer relationships. Strong brands, network effects, regulatory barriers, switching costs, and proprietary technology can all create moats. Without one, a company is constantly vulnerable to rivals offering cheaper or better alternatives. A company that hopes to last for a century must be able to defend its position in the market across multiple generations of competition. The third requirement is financial discipline. Many companies fail not because their products are bad, but because they overextend themselves financially. Excessive debt, aggressive expansion, and risky acquisitions can destroy even strong businesses. Long-lived companies typically maintain conservative balance sheets, healthy cash flows, and focus on sustainability rather than rapid growth at any cost. They prepare for downturns instead of assuming prosperity will last forever. The final requirement is adaptability. The world changes, and businesses must change with it. However, adaptability does not mean abandoning core principles. The most enduring companies evolve their products, technologies, and strategies while staying true to their fundamental purpose. Now that we understand the basic framework, let's imagine how the 100-year stock test might apply to real-world businesses. Imagine a company that provides essential healthcare products. Demand for healthcare is unlikely to disappear, and in fact, it may grow as populations age. If that company also has strong research capabilities, trusted branding, and global distribution, it may be well positioned to survive for decades. Similarly, consider a business that supplies critical infrastructure, such as energy or water utilities. These services are deeply embedded in society and often protected by regulation. While technologies may change, the need for reliable utilities remains constant. Consumer staples companies, such as those producing food, beverages, and household goods, also have enduring demand. People may switch brands occasionally, but they rarely stop buying these products altogether. Now contrast that with a business built around short-lived trends or narrow technological niches. A company that depends on a single platform, fad, or speculative technology may grow quickly, but it is far less likely to endure. The 100-year stock test is not about predicting the future perfectly. It's about identifying structural strength. A useful way to think about this is to ask a simple question. Would this business still make sense in a world that looks very different from today? Would it still serve a fundamental need? Would it still have loyal customers? Would it still generate reliable cash flow? If the answer is yes, the company may have the potential for long-term endurance. Another important factor is corporate culture. Many of the longest-serving companies emphasise long-term thinking over short-term profits. They invest in their people, their reputation, and their relationships with customers and communities. They avoid reckless behaviour, even when it might produce short-term gains. They understand that trust, once lost, is difficult to regain. Family-controlled businesses, for example, often take a generational view of success, rather than focusing solely on quarterly earnings. While not all family firms succeed, some of the world's oldest companies share this long-term mindset. Now let's consider the role of innovation. Innovation is essential, but it must be balanced with stability. Companies that innovate recklessly can lose focus, while those that resist change can become obsolete. The most enduring businesses innovate thoughtfully, improving their products and processes without abandoning their core mission. For example, a company that began by selling physical products might later expand into digital services. A manufacturer might adopt new technologies to improve efficiency. A retailer might embrace online distribution. The key is evolution, not reinvention for its own sake. Another major factor in long-term survival is risk management. Companies that last a century are rarely those that take extreme risks. Instead, they prepare for uncertainty. They maintain financial buffers. They diversify revenue streams. They avoid dependence on a single market or customer. They understand that downturns, crises, and disruptions are inevitable. Survival depends on preparation. For investors, this perspective is incredibly valuable. Most market participants focus on short-term performance. They chase momentum, trends, and headlines. But long-term value investors look for durability. They ask whether a company can withstand adversity, not just thrive in the good times. The 100-year stock test shifts the focus from excitement to endurance. Instead of asking, how fast is this company growing? We ask, how strong is its foundation? Instead of asking, what's the next big thing? We ask, what will still matter in decades from now? This mindset helps investors avoid many common mistakes. It reduces the temptation to chase hype. It encourages patience. And it emphasises the importance of financial strength, business quality, and long-term thinking. Of course, no one can predict which companies will still exist in 100 years. Even the strongest businesses face uncertainty. But by focusing on structural advantages rather than short-term performance, investors can improve their odds of choosing resilient companies. It's also worth remembering that long-term success does not require constant excitement. Many of the most durable businesses are, quite frankly, boring. They operate in stable industries, they grow steadily, they generate reliable cash flow. They may not dominate headlines, but they often dominate over time. The stock market rewards patience more than brilliance. It rewards discipline more than excitement. And it rewards durability more than speed. When investors align themselves with businesses built for the long haul, they benefit from compounding, stability, and reduced risk. In contrast, companies built on fragile foundations may deliver impressive returns briefly, but they often struggle to endure. The 100-year stock test reminds us that investing is not just about making money. It's about preserving capital, minimising risk, and building wealth sustainably. It encourages us to think like owners rather than traders. Owners care about the long-term health of a business. They care about balance sheets, culture, strategy, and resilience. Traders care about price movements. Value investing has always been closer to ownership than speculation. Benjamin Graham emphasised margin of safety. Warren Buffett emphasised business quality and durability. These principles align perfectly with the idea of long-term survival. A company that can endure for a century is likely to have strong financials, a defensible market position, consistent demand, and adaptable leadership. While not every investment must pass the 100-year stock test, using it as a mental framework can improve decision-making. It forces investors to think beyond charts and projections. It shifts the focus to the fundamentals. And it reminds us that true wealth is built slowly, steadily, and intelligently. As we look ahead to the future, markets will continue to change. Technologies will evolve. New industries will emerge. And old ones will fade. But human needs, sound financial principles, and disciplined business practices will remain. And the companies that align with those realities are the ones most likely to endure. Investing, at its core, is an exercise in trust. We trust that a business will continue to create value. We trust that the management will act responsibly. We trust that the financial structure is strong enough to withstand adversity. The 100-year stock test helps us evaluate that trust. It encourages us to invest not in stories, but in structures. Not in excitement, but in endurance. And that perspective can make all the difference over the long run. And that is all for this edition of Intelligent Investment today. I hope that you've enjoyed considering what it truly takes for a company to stand the test of time. In a world of constant change, long-term success belongs to businesses built on strong foundations, disciplined finance, and enduring value. I'm David Coombs. This has been Intelligent Investment today. Thanks for listening, and until next time, stay safe and happy investing.